first update. We're in the process of finishing our big quarterly piece, which should be released in the next few weeks. So we're kind of trying to pull out some of the highlights from that, taking a look through performance over 2019, and then kind of pulling through to some of the main aspects that we're focused on and incorporating into the model portfolios. Just in terms of a super quick recap, last year, despite if you sort of stood back from the markets and looked at some of the events in terms of Trump versus China and the escalating trade wars, the ongoing uncertainty of Brexit and the sort of back and forth negotiations between the UK and EU, is actually an incredibly strong year for equities. Right at the end, we had a big risk-on rally, Santa Claus rally into the end of the year, and it's been a little bit more mixed as we started 2020. One of the difficulties that we faced being an absolute return investor has been the sort of decision to stand back and look at the rally rather than be involved just because equity markets seem like they're pushing higher. So we have gone through this evolution over the course of 2019 as markets have become increasingly more expensive, especially in the second half of the year. But this is despite some of the ongoing development of events. So just in terms of highlighting sort of global equities coming in the mid 20% and US equities nearing 30, depending on which index you're looking at. But even some of the bonds really delivered on the high yield and emerging market front. So we're going to just sort of take a little dive in, work our way around, and try and give you some thoughts and highlights on how we're positioned going forward. Before we do that, just in terms of a look back at performance for 2019, we finished, I've just put up dollars, euros and sterling balanced portfolio numbers. So our sort of year-to-date number for the full year was up 15% for dollars, 13.8% for euros and 12.5% for sterling. These are all absolute return mandates. So the concept of a balanced portfolio is CPI plus 2 to 3%. So our target return is realistically for developed markets sort of that 4 to 5% level. Our focus point has been more on the volatility aspect. So from our perspective, to return 14.5, 15% in dollars, but with a volatility of just over 4%. And you can kind of see that kicking through in the bottom 6 months of the year when we've really taken a lot of the volatility out of the portfolio and tried to concentrate on generating these month-on-month returns. We had such a strong start to the year when the equity markets were rallying. As we got further into the second half of the year, we felt that the valuations became more unjustifiable to pull down on the risk front. This has meant that our performance lagged the broader equity markets in the second half of the year, but that's not what we're focused on, because we're focused on trying to deliver these absolute returns for our clients. So it was nice for us, despite some of the volatility that we saw midway through 2019, we finished for our dollar-based clients anyway with 12 consecutive months of positive performance. That's the sort of low volatility, consistent returns that we're trying to achieve. I am going to pass you across to Jeff rather than talk to you non-stop for 30 minutes, to have Jeff talk to you a little bit about some of the fixed income views and holdings that we have.
Great, thank you, Simon. So let's just recap on some of our existing positions and what we've changed going into the new year. We're still overweight and long US Treasuries. We're underweight on the European benchmark government bonds, and we're neutral with a slight preference for shorter dated gilts on the UK government curve. We've also executed 2 tranches now in European high yield, and we've explained earlier this month 5 reasons why we like it. And that's one, first of all, it offers 3.5 times more spread when compared to European investment grade. It's also attractive when compared to the US high yield index. That's both due to its sector composition and also its much lower composition of CCC rated bonds, which have a much higher default rate. And also there's favorable convexity in the European high yield market versus US, which means that there's more potential for price appreciation. And we've expressed this view by using ETFs. There's one in particular which has 500 constituent bonds, which is a good representation of the underlying benchmark, and it's also highly liquid. So we've used that to express our trade idea. And last but not least, in the emerging markets, we've seen very strong risk-adjusted return through 2019, and we now prefer the shorter end of those curves where there's still a very steep front end of the curve. And separately, we did also reduce our allocations in US investment grade after a very strong performance last year, and similarly in US high yield as well, where we've decisively now moved to an underweight position. Now, the returns from last year helps to build that picture and set the story for where we're going next year. So December was a very strong finish for risk assets for all three of the major markets, dollars, euros, and sterling, to what was already a superlative year. You can see that there's strong excess returns in high yield in all three markets. And we saw a year-end sell-off in treasuries, and that was due to the rotation into equities and also high yield as well. And that was mostly driven by progress on the wording between the phase one part of the deal between the US and China. But we take that with a pinch of salt, given that Trump could quite easily just turn around with a new tweet from his Twitter account and overturn all of that. So we didn't chase the rally into the year end, and we didn't follow core equities and US high yield either. Separately, the Fed has kept rates unchanged in its final meeting of the year, and the market implied probabilities of any rate movement in the next 6 meetings between now and the US election is close to zero. It's pretty much negligible. Macro data is now superseded by trade war developments, but nevertheless, new home building data was very strong, but that was against the backdrop of stagnant corporate profits growth, and also some signs of weakness in margins as well. Now, in terms of the shape of the curve, we've seen a slight inversion pop back up again, where you can actually gain a few basis points on the 3 and 6 month T-bills compared to the 1 year. That said, we still much prefer being in the longer end of the curve. And just coming back to performance again, we've already made some gains on our European high yield position. We're talking about 2% return over rates in the space of a month. And then similarly, we've made 1.5% in our sterling investment grade positions post-election. Now, if we look forward into 2020, we're thinking that we've moved into a new regime where rates will remain lower for longer. And that's based on 2 reasons. Inflation expectations will remain muted in 2020, and corporates are now addicted and dependent on low borrowing rates. And thirdly, we've also got aggregate balance sheet expansion from both the Federal Reserve, the European Central Bank, and also the Bank of Japan. And it should amount to almost $1 trillion US. And all that additional liquidity has to go somewhere. And we don't expect the Fed to increase rates or cut rates either. And you can see that treasuries yields have always been anchored and followed the federal funds rate, which is currently set between 1.75% to 2%. And the markets currently don't expect, we can't see any conclusion to the rate cutting cycle. And for that reason, we think that treasuries will trade range bound between 1.75% and 2% going into the remainder of next year. So we're happy to earn the coupon, and we're not fearful of capital loss. And for that reason, we still think that carry is still the name of the game, as we had pointed out last month. Moving into Europe, we're more focused on the technical factors, namely bond scarcity and also the resumption of the quantitative easing program, which will provide a bid for euro-denominated sovereign bonds alongside private investors. What I'm trying to show here is gross issuance. These are our estimates across the main countries. You've got the core issuers, Germany, Austria, the semi-core, which is France and Belgium, and also the periphery countries, namely Italy, Greece, Portugal, and Ireland as well. We should see a slight tick up in issuance from the core countries and a slight decline in the peripheral countries. But what's most important is that with the ECB buying alongside private investors, what remains in net new issuance in next year is just 47 billion. Now, if you think of that number in the context of the trillions of euros that the pension funds have across Europe and the coupons that they have that they will need to reinvest, we don't think that there'll be sufficient new supply in order to meet the demands of the private investors. And for that reason, we think there will be naturally a drive for the secondary market, which will drive yields tighter, which supports our thesis and our current position in Italian and Greek government bonds, which are both positive yielding. Moving finally to the picture in the UK, we did see a relief rally after the general election, and now that's behind us. Boris and his team still have 11 months to strike a trade deal with the EU. But what's most important, what we're focused on as credit investors, is the additional public spending and the government borrowing that will come with that. And we expect with a majority Conservative government, we've already heard the Chancellor say he's vowed billions of additional spending. He's spoken about removing debt ratio targets. He's also spoken about splitting current spending from investment spending and capitalising on the low rate environment in order to fund large-scale infrastructure projects. So with that glut of supply that's going to come along, we think that will place upward pressure on the UK gilt curve. Moving into corporates in the sterling space, we think that we've seen a return in lender confidence. We think there will be a material return to sterling capital markets, which would drive spreads tighter. But with the offsetting factor of the higher yields, we think that all-in corporate borrowing costs will be roughly flat on the year. And the other factor that we've got to look out for going into next year is the Bank of England with its new governor who will be steering the course. In the final MPC committee meeting of last year, only 2 members voted for a rate cut. Now, we don't see strong enough reasoning, rationale, or data points to support a rate cut just yet, because the labour market is still very buoyant. But over the last 3 years, we've seen a persistent lack of investment, and that's resulted in a fall in new orders, which has led to a fall in companies' appetite to hire. So we've also been seeing the weakness in PMI data, and companies aren't actually replacing departing staff. So while that doesn't worry us right now, it's certainly a development that we'll follow through the remainder of this year. So as again, we don't expect any action from the Bank of England between now and the end of the year, and we remain neutral with a slightly overweight position on the shorter end of the gilt curve. And with that, I'll pass that back to Simon.
Just in terms of the key takeaway on the fixed income side, that European high yield position has fed its way into every one of our discretionary portfolios across all base currencies and every multi-asset. This is one of our key satellite holdings that's playing off against the core, which is driven by the base currency. So we have put in multiple tranches of that. We're comfortable with the position. Obviously, even for conservative clients, it's appropriate to hold a small allocation in high yield. Just moving on to equities. Jeff has much more green from a fixed income perspective than we have on the equity side. We're running equities with 2 different strategies, the core strategy and the satellites being the thematic single stocks and the core being our broad global equity exposure. The reason why there's so much orange and red on there is because we don't currently hold any core equities. It's been slightly painful as an investment team watching equity markets rallying into the end of the year, knowing that we're not sitting in a rally, but this is where we have to stop and look at ourselves and say, why aren't we participating in the rally? This is the concept of having this macro valuation sentiment technicals regime and structure around the decision-making process, so that when we are looking at it, we don't get carried away by trying to chase the market higher. We stand back and we look at where is the S&P 500 trading. If it's at an 18.5 PE ratio, how many times historically has it been at an 18.5 PE ratio? and over the next 6 months made clients money. And from our perspective, we are always trying to take it back to the concept of preservation of capital is priority number one. So we're then looking at it saying, can we justify holding exposure just for the sake of holding exposure? Do we want to copy what the neighbor is doing, or do we want to look at it from our own perspective and make our own decisions? When we're looking at it from a valuation perspective, it does look very, very stretched. Partly this is coming from, as Jeff was showing in December, people taking money out of government bonds and piling them into high yield, into emerging market bonds and into the equity market. You know, we've seen some individual stocks have incredible performance in 2019, but what we're looking at now is how sustainable is that going forward? We can't predict what's going to happen over the course of the next month accurately in equities, but we can look and say, historically, when equities have been trading on this sort of valuation, the markets have been negative over the next 6 months. We think that it's very, very expensive where it's currently positioned when you're having to pay so much now just for sort of per dollar of earnings that you're going to get from an American company. That's also the case in Europe and the UK. And when you look down that valuation column, that's essentially almost global from where we are, because it has been a fairly broad rally. When we start looking around even at technical levels, looking at investor sentiment, it's telling, apart from Japan on the sentiment front, a similar story. This means that we have to be comfortable in our own positioning because we need to have conviction in our positioning. We're not entirely out of equities because we have the satellite exposure, but we never want to be in the position where we're owning just because we feel like we should be owning, or we have to be owning, or because we're under pressure to be owning. You know, we get a lot of questions in terms of, well, how can you have 40% of the model sitting in cash or equivalent government bonds? And the answer is because cash is king. We want the liquidity, we want the security. We don't just want to be importing volatility into client portfolios. So this is looking at the forward PE ratio, and that's showing that we're sort of not too far off, 2 standard deviations above the norm. That's generally, as you can see, going back to 2010, only been the case just before we had a big pullback. We were looking at the CAPE ratio, the cyclically adjusted price earnings ratio, and there's only, I think, 2 occasions prior to the current levels when it's been higher than where it is now. One of those was just before the dot-com bubble, and one of those was back in 1929. We're not predicting that we're going to have a massive pullback over the course of 2020, but we do think we're going to get some pockets of volatility, and we're doing our best to try and absorb those and keep them out of the client portfolios. And this is the similar sort of graph showing you, just from a valuation perspective, how far the S&P 500 has come. When we stand back and look at it, it means it's not being driven by fundamentals. We're not seeing massive upticks in companies' earnings expectations. And that's what we need in order for that to rebalance. So when we do start to see ratios moving higher, at the same time as we're seeing earnings expectations being declining, that's not leveling up for a long-term sustainable equity market return, especially when the equity market rally was north of 25%, which is what we saw over the last 12 months. And this is our worm chart, as we call it. When we're starting to look at the 2020 earnings, it's not necessarily for the US a very, very negative line, but you can already see in Euro stocks, FTSE is currency driven as well, but you can already start to see that earnings are being revised down for 2020. That's not helpful when we're looking at 18.5 PE ratio and you're spending $18.50 per dollar of profit, which is where we're sort of currently positioned. So we're, from a core equity perspective, very cautious. We're sitting out on the sidelines. That's not going to be our stance for the entirety of the year. If we do get a sort of 7%, 10% pullback over the coming 2 to 3 months, then we would use that as an opportunity to take some exposure. And we do that fairly quickly depending on the mandate that we're looking at. But that's our stance at the moment, and that's how we want into 2020, and that's how we're comfortable from a positioning perspective. We're still using sentiment from a inverse perspective, so a contrarian indicator, and people are too bullish. It was a rally done on lack of alternatives, too much cash, people wanting to try and tidy up numbers for year end, We got to the point where RSIs are too high and people are being too high with their expectations for the coming year. From an equity satellite perspective, I'm going to skip through this slide because we've shown this quite a few times before, but the concept of what's driving markets and what's going to drive stocks over the next 5 to 10 years. We've been looking at 4 sort of key components of this. The numbers in terms of EM consumer up 20%, that's the outperformance versus the emerging markets index through following this thematic idea. We're looking at, and some of the numbers are mind-blowing when you start to look at India. Their domestic consumption in 2018 was $1.5 trillion. By 2023, it's expected to be $6 trillion, 4 times increase in essentially 5 years. So we're, from the emerging market consumer, this is domestic consumption. We're starting to look at, okay, so if they are going to have this amount of increase, and $4.5 trillion is not nothing, where's it going to be spent and how do we invest and get some exposure to that? And that's India. Then when you start to add in all of the other countries that we're looking from an emerging market consumer base, this is why this trend and this sector has done so well. And this is one of our key core sectors that we're looking at. We're holding some exposure to it in the portfolios through individual stocks, and we're going to hold that through into 2020 and beyond. And some of that is made up of video games on the right-hand side, which again had incredibly strong performance. For video games, we're sitting in both emerging market and developed market individual stocks. I've got some performance numbers on the next page. Online life, same sort of concept of been looking at the rollout of 5G, internet, e-commerce in developed and emerging markets. The defensive value, which was down versus the value index, was 2 positions that we held and exited both at a profit. So in terms of positions that we've currently got open, up the top, we've got Tencent, Electronic Arts and Mail.ru. There are 3 key holdings that we're sitting on within the thematic side. The 2 stocks right at the bottom, Peugeot and Volkswagen, both sat within our defensives aim, but we took both of them out with just shy of a 10% profit, having held them for between 1 to 3 months. Where we're positioned, and you can see Electronic Arts with a just under 21% rally in the last few months of the year. We're wanting to have exposure to those individual stocks where we don't feel like we're chasing the market higher. Our watch list of stocks is 3 times longer than our holding list of stocks, but we're in a position where we don't want to run and we don't want to own just to have to say we're at 8%, 10%, 25% of equity. We have our watch list, we have our stocks, we have what we're looking at from a thematic idea perspective. And when we start having some market realignment, we use that as an opportunity both to take individual stock positions and broader equity exposure. But from our perspective, when we're looking out at 2020, we have our shopping list. We're going to add to that as and when they get in range. But 2020 is going to be a year to be nimble. And we are going to see some market volatility, but it's going to be navigating around that. And this is where the absolute return focus comes into its own. Before I ask if anyone's got any questions, there's 2 questions that we're getting quite a lot at the moment. Firstly, are we going to get a recession in 2020? We've had that from quite a few clients. Our answer is no. And the reason for our answer being no is based on a couple of different aspects. Number one, we've already seen the Fed cutting as sort of insurance cuts in 2019. We're sitting at interest rates that are 75 bips below where they were a year ago. We don't think the Fed's going to cut anymore, but we think that they've proactively cut so that we can sit through this election year without them having to take any action. Some of the other components that are adding on to this is the US doesn't want a recession. The US doesn't really want a trade war with China. The US doesn't really want the other question, which is the situation with Iran, to escalate too much further, because the US does want to continue to grow. So does the consumer. And we've seen since 2009, the sort of net household worth of US consumers has doubled. but their consumption spending hasn't gone up as quickly because their savings ratio has increased. So we're looking at a US consumer that has a better bolstered balance sheet if we look at it from the same perspective. So the consumer's being cautious and the economy is continuing to grow but sluggish, but there is some capacity and space in there. But we have seen around the world central banks moving to a more expansionary sort of fiscal policy and looser monetary policy, which we think is going to help the economy continue for another 12 to 18 months before we start to get some sort of potential pullback. On Iran, before I get asked the question, because we've already had a few questions coming in, we did put out a piece on it that was prior to Iran firing multiple missiles at two US military bases in Iraq. We're of the opinion that it's not going to lead to World War III. We've seen the retaliation by Iran. I'm hopeful that this is where it ends. They've kind of done their retaliation. There's been some stern rebukes verbally in terms of don't take this any further. Iran is struggling in terms of it's had the sanctions from the US, it's had lack of investment into its petroleum reserves and extraction and refining. They've continued to sell to China and a small number of other nations. They can't really afford to get into a drawn out war with the US. Trump, and I'm sure many people have seen the tweets that he sent when Obama was up for re-election about Obama going to start a war with Iran to try and get re-elected. And ironically, now it's him going through this whole process. He's had, the US has had a huge amount of pain in the Middle East over the last 10 to 15 years, and they don't really want to get back into that when they've got enough issues at home to be focusing on. Great. Thank you all for coming.